Okay, we're into standard 5. This deals with investment analysis, recommendations, and actions. Very important section. I mean, frankly, they're all important, but when you think about the responsibility of a professional to guide their clients, certainly the recommendations, analysis, and actions that you provide are what they're paying you for, and they expect certain things. So standard 5A talks about diligence and reasonable basis. So what this says is members and candidates must exercise diligence, independence, and thoroughness. Those are 3 keywords: diligence, independence, and thoroughness in analyzing investments, making investment recommendations, and taking investment action. And once you've done that, you have to have a reasonable and adequate, okay, 2 keywords, reasonable and adequate basis supported by appropriate research and investigation for any investment analysis, recommendation, or action. Okay, so this is our ethical responsibility. You know, the thing about ethics is that it's one step above legal obligations, right? So you're not legally obligated to do this, to make recommendations, but ethically, we need to go above and beyond the legal requirements. So being diligent and having a reasonable basis for making recommendations to our clients is at the heart of one of the core ethical responsibilities. Specific conduct required to meet the diligence and thoroughness requirement will depend on several factors: the investment philosophy, the role in the investment decision-making process that the advisor has, and whatever support there may be from the firm. What's essential here is that we provide clients with information supporting your investment recommendation. So the more transparent and thorough we are, the more confidence the client can have that we've done our due diligence or our homework. So the level of diligence and reasonable basis will differ from product to service. Reasonable basis formed by diligently balancing resources available for analyzing. So consider the following: the bigger picture of the economy, macroeconomic conditions, the financial history of the industry and the firm, the industry conditions that are going on, the fee structure and management, and the quantitative model output and limitations. And the thing to keep in mind is we can make decisions based only on current available information. We don't want to speculate about the future, or that the past is an indication of the future. We want to talk about what's available, what's in front of us at this particular point in time. So one of the ethical responsibilities we have is to evaluate the reliability of research sources and research conducted by others incorporated in our recommendations. The truth is that most advisors don't have time to do primary research, so they have to rely upon others to do it. So there's really 3 categories of potential research. One is what's called secondary research. That's research from colleagues within the firm. So this might be full-time professionals whose main job is to research firms and industries. And you can rely on management or others for due diligence with regard to the thoroughness of that particular research. But you do need to confirm the policies for review to ensure ongoing quality and reliability of the data. If you're taking third-party research from banks or investment firms outside of your particular company, then you have to ensure that that is also of high quality and reliable. If you're taking research from internet sources, then you should consider that less reliable and less significant to what you're going to analyze and recommend to your client. So in addition to relying upon secondary or third levels of research, one might also use quantitative research models. And what the ethical responsibility of the analyst is to understand the assumptions and limitations of any quantitative models, computer-generated models that are used in his or her research. If the analyst is developing their own models, then they have to understand and test the technical aspects of the model prior to its use. And it should be tested with a broad range of assumptions, including extremely positive and negative scenarios. And one has to look at the time horizon and the data inputs in terms of the testing parameters. On occasion, you may want to have a sub-advisor, an external sub-advisor, to help with a particular client or a particular firm or industry. And the ethical guidelines require us to have a diligence process to ensure that that sub-advisor investment process is sound, that they adhere to whatever mandate that they are given for that investment fund, to review the quality of services and investment performance that they've provided to others, and including compliance with internal control procedures the firm, the external sub-advisor may have, existence of a code of ethics, and adherence to industry standards, for example, the CFA Institute Manager Code or the Global Investment Performance Standards. So group recommendations or research. So if we have group recommendations or research, so oftentimes the investment professional is part of a group. What may happen on occasion is the consensus of the group may come up with a conclusion that the individual does not agree with. So as long as the investment professional is confident in the groups, has worked in the professional, done the due diligence, done an appropriate professional analysis, they don't have to agree with the consensus to enable that perspective to go forward with his or her name on it. Doesn't mean they adopt that perspective, but they don't have to recuse themselves from it, as long as they believe that the process was diligent and conclusions were reasonable. So let's look at a few cases now that will apply standard 5A. So Witt works as an investment analyst for an independent internet research company and publishes a recommendation and report on different company every month. Witt monitors a number of discussion boards that generally have positive comments on the technology sector and discuss the prospect of specific companies. Under pressure to produce the next recommendation, Witt creates a report based on the content of the discussion board, a few news articles, and what the conventional wisdom of the market has deemed the latest hot securities. What do you think about Witt's actions? Okay, they're inappropriate because he did not use diligence in conducting the research, and his report does not have a reasonable basis. Right, so keep in mind that there's primary research, there's secondary research, and there's third-party research, and this falls outside the realm of all of those. So we'll look at one more case here. Green works for Peach Asset Management, where he creates proprietary models that analyze data from the firm's request for proposal. He uses questionnaires to identify managers for possible inclusion in the firm's fund investment platform. Managers must meet various criteria to be accepted to the platform. Because of the number of respondents to the questionnaires, Green uses only data submitted to determine whether a particular manager is added to the approved list. Green's actions are inappropriate because Green fails to conduct any additional review outside of the information submitted by the firm in the RFP. Okay, so let's look at compliance practices. So compliance practices for standard 5A, we appoint a person, committee to review reports and recommendations, develop guidance for determining diligence, reasonable basis, and accuracy over time, develop a minimum level of scenario testing of quantitative models, and establish criteria for assessing outside research providers. So to summarize, exercise diligence and thoroughness and have a reasonable and adequate basis for decisions and actions. Specific conduct required will depend on the number of factors, including the role in the investment process and support of the firm. Evaluate the thoroughness and reliability of research and investment services of others that are adopted or utilized. For quantitative research, understand the parameters, processes, and assumptions. And for group research, process should be thorough and the conclusions reasonable. All right, let's look at section 5B. Members, this deals with communication with clients and prospective clients. So we must disclose to clients, prospective clients, the basic format and general principles of the investment process they use to analyze investments, select securities, and construct portfolios, and must promptly disclose any changes that might materially affect those processes. So our clients and our prospective clients have to be thoroughly familiar with our general principles and our processes. We also have to disclose to clients and prospective clients significant limitations and risks associated with the investment process. So you really want to protect yourself, right? Talking about your limitation of insight and analysis and the risks associated with any investment. There's always some risk involved. Obviously, some have more than others. You must use reasonable judgment in identifying which factors are important to the investment analysis, recommendations, or actions, and include those factors in communication with clients and prospective clients. Okay, so we have to give them all material information, be as transparent as possible. And very important, distinguish between facts and opinion on the presentation of investment analysis and recommendation. Okay, so anything about the future is generally an opinion. Historical information are generally facts. Communications with clients is critical to providing high quality financial services. You must describe the investment decision-making process that you plan to use, keep clients informed on an ongoing basis about changes, and communication gives investors a thorough understanding of their investments and allows them to make informed decisions. So it's not up to you to decide how much risk a client should or should not take. What your role is to inform the client about the risk-reward ratio. That the more reward they expect, generally speaking, the more risk they have to take. And with risk comes the opportunity for both upside and for downside. So if a client is more risk adverse, then you can create a more conservative, less risk portfolio. But in almost all cases, it's going to have a much lower return than something that has more risk. So understanding the investment process helps investors gauge impact on portfolio. So if they know what your methodology is, what process you use to make adjustments, and disclose of any external advisors to allow a complete understanding of the investment decision-making process. So you must communicate significant risk and limitations of investment analysis, including the following: the leverage that exists with a particular firm. So leverage deals with this: how much debt does a particular firm have? The market-related risk. Okay, so during times of as we experienced recently with COVID, that increases the level of market-related risk. The counterparty risk that may exist. And then looking at market or sector risk. Okay, so every market, some markets or sectors are more stable than others, and some are more volatile. So we have to make sure that our clients are fully aware of everything that we can provide them so they can make an informed decision. And then, of course, the security-specific risk. So when we talk about security-specific risk, we're talking about the individual security that we're looking at. Is there any risk involved with that? If so, how much? And then the credit risk. An adequacy of risk disclosure is based on what is known at the time. Okay, so if something happens later, you should inform your client, but you won't expect it to inform them at that time. But you don't want to withhold anything that you know that could reasonably influence the decision, you want to make sure you put on the table. So it must include elements that are important to the analysis and the reports or recommendations, can emphasize particular areas while generally addressing others or omitting what is unimportant. So you can certainly talk about things in a particular emphasis. If they're not significant or they're unimportant, you can omit them, but it's better to err on the side of including than excluding, because you don't want later to be found to have excluded something that they might have influenced somebody's decision. Quantitative analysis must be supported by reference materials, and any changes to the methodology over time has to be disclosed. Separate facts from opinion. Future predictions, earning estimates, dividend changes are opinion. So the future is always an opinion. Identify the limits of statistically developed projections and use caution in promoting future accuracies of any model, noting that output is an estimate of future results. So communication is not confined to written research, reports, or recommendations, but can include in-person discussion, telephone conversations, media broadcast, computer communications, internet, social media. So in the nature of the communication brief, make clear that the additional information is available on request. All right, let's look at a few cases now. All right, let's look at these cases. So Morales is an active value-style equity manager who selects stocks by using a combination of 4 multi-factor models. In exploring new investing strategies, Morales has found favorable results when back-testing the most recent 10 years of available market data in new dividend discount model. This model is based on projected inflation rates, earning growth rates, and interest rates. Morales decides to replace the investment model that focuses on historical price to trailing 12-month earnings with new strategies based partly on future projections. Morales' actions are inappropriate unless he discloses the changes in the investment process to his clients. So pretty straightforward. But okay, we'll look at one more. Khan is a mining analyst who is drafting a research report on Botany Bay minerals. He includes in his report his own assessment of the geological extent of mineral reserves likely to be found on the company's land. Khan based his calculation on data the company provides on the core samples from its most recent drilling. According to Khan, the company has more than 500,000 ounces of gold on the property. He concludes his research report with the statement, because the company has 500,000 ounces of gold to be mined, I recommend a strong buy. Khan's actions are inappropriate because his report does not separate fact from opinion. All right, so let's look at compliance practices. Have rigorous methodology for reviewing research communicated publicly. Maintain records supporting the research. Supply additional information about the research not included in the report when asked. So to summarize, disclose the basic format and general principles of the investment process and promptly disclose changes. Disclose significant limitations and risks of investments, including the use of leverage and risks related to markets, counterparties, and securities. Identify factors that are important to the investment decision-making process and omit what is unimportant. Distinguish between fact and opinion. All right, let's look at standard 5C. 5C deals with record retention. Members and candidates must develop and maintain appropriate records to support their investment analysis, recommendations, actions, and other investment-related communications with clients and prospective clients. May retain records in hard copy or electronic form. Records can include the following: notes, press releases, presentations, computer output analysis, risk analysis, selection criteria, notes from client meetings. So if in doubt, retain it. New technological formats present challenges. Putting something on a blog or Instagram, but you must keep records of a communication sent through email, text, blog posts, social media. They're very, very, very important. Maintain or archive electronic records. Records are the property of the firm. You cannot take records or copies of records when changing employers without written permission. You cannot recreate supporting records. You can recreate supporting records when necessary. Follow regulatory record retention requirements. The CFA recommends 7 years. Okay, let's look at a couple of cases. Ayanada is the Chief Compliance Officer for Rocky Mountain Investment and responsible for establishing appropriate compliance policies for the firm. RMI has rapidly expanded over the years, and Ayanada determines that the firm should move to a new and cheaper email archive provider. But during the transition, several thousand emails are temporarily inaccessible. In addition, the new system does not archive emails from accounts hosted on server external to RMI, and does not archive emails sent from third-party software provider application, cloud email. Ayanada's actions are inappropriate because the record retention process is inadequate. Okay, I'll let you read through these other two, fairly self-explanatory record retention cases. So when we talk about record retention, we must maintain appropriate records to support the investment decision-making process and their communication with clients. Records can be maintained in hard copy or electronic. Records are the property of the firm and cannot be copied or taken without permission. And as a general rule, you should maintain your records for at least 7 years.